Welcome to the next episode of The Local. We're going to continue something we touch on occasionally, which is deep diving a bit more into some of the technical aspects that come out with building a market-making business, building a trading business, some of the fundamentals you need to get that right. We're at the coalface doing that. Not saying we do it better than anyone else, or sometimes even that well. But we
well enough to still be in business.
Well enough to still be in business, and there is, regardless of how it's been earned, there is some knowledge that's contained within these two shiny domes in this space, and it's probably not cutting edge, but it's certainly earned through hard graft, right? And so we've touched on in previous episodes, you know, the nuances of what actually is a price, which seems like a ridiculous question. But as soon as you understand that on any venue or any exchange in particular, there is at least two prices that can be traded at, then that begins to expand the mind. And then you go, okay, well, there's more than one venue, and suddenly you realise that the price of the asset is not that static.
It's fuzzy. Yeah, not well.
And so the pricing side, interesting, or what is a price? What are we trying to do? And then I think in the last one we talked about getting the information to us.
Because we realised we'd kind of started a little bit too.
I think that's
too
first.
far along, and we realised we need to go back a little bit.
I think that's first, but you're right. It's the other way around, isn't it? A scale is get this information that shows us that there's two prices or more. Yeah, okay.
So I think we kind of
backtracked.
We kind of
we backtracked on.
Yeah. Well, it's a non-linear.
It's like a graph.
Yeah, exactly. Yeah, it's like Pulp Fiction.
Okay.
Where the scenes are in different order.
Yeah.
And it's up to the viewer to put it all together.
Yeah. Okay, that makes sense. Today we're going to talk about, once you get that price information over the network that we talked about before, how you begin to think about
using it,
and what, particularly as a business that primarily puts in limit orders or passive liquidity into order books, how you think about where the right price level is for that to happen.
I think the deep question is, what are you trying to do?
Yes.
So what is a market maker actually trying to achieve by placing orders into the market?
So what is a market maker trying to achieve? I mean, there's two flavours there that we can touch on as well.
So I would, in my answer, I would say we are trying to retain some of the spread.
And what's the spread?
The spread is the difference between these two prices, right?
Okay.
So in general, we're just going to talk about central limit order books. We're not going to talk about DeFi pools yet. We will talk about DeFi pools. But let's just talk about central limit order book. You have the bid prices, and you have the ask prices, right? So the bid price is how much you'll pay for something. The ask price is how much you'll sell it for.
Yep.
And these prices in general are the highest bid price and the lowest ask price have got a gap between them.
Yep. And usually sort of engineered, like by price tick size, because if they're the same price,
might be a choice market. And
trades happening.
Yeah, exactly. Normally when there's a prices match, usually a trade happens.
Yep.
Typically, not always.
But
we won't talk about some FX markets here.
Or post only.
Yeah, exactly. This difference is generally called the spread.
Yeah.
And what I think the central goal of a market maker is as flow comes to you, so as you place orders at various bid prices and various ask prices, over time, you will capture this difference, a proportion of this difference, without having any exposure to the underlying asset price moves.
Okay.
So we're not interested, as market makers, in buying Bitcoin because we think Bitcoin's going to go up in price.
Which is like kind of fundamental, because market makers, particularly in crypto, get tainted with this a lot about, you're taking directional views on, you're crushing token prices and stuff.
Yeah.
But if they're genuinely market making, what you're saying is that they don't do that.
Market makers shouldn't have any interest in the directional view if they're doing pure market making.
Yeah. And so the idea, is, so directional views might be one way of expressing. Directional view might be one way of trying to make money.
Yeah, it's a perfectly legitimate way of trying to make money.
Yeah.
If you're going to be in a stat arb hedge fund or something like that, you're going to be betting that one thing's
things revert or comes together.
Things move. There's a direction.
There's a relationship between these things. I'll try and monetize it.
Yeah, exactly. Or you could be super discretionary and go, my vibe is that Nvidia's going to go up, so I'm going to buy some.
Right.
Market makers not doing that.
No.
So we don't have a directional view, and so what we are trying to do, because obviously we're not a charity.
Yep.
We're trying to make money. What we're trying to do is over time, and it has to be over time. You can't. You could do it in two trades.
In 2 trades.
You could do it in 2 trades, but it's
Yeah.
in general, this is expressed over a lot of turnover.
So there's law of large number stuff.
That comes in.
And this is market makers in general that are, and we've talked about whether this is a strategy or not, or whether it's like a
service.
A service.
Yeah. We've talked about that, whether we think it's kind of both.
Okay. And so
it's not risk-free.
No.
If it was a service, you might consider it risk-free, right? But of course, even though you're trying to not have any directional exposure to the price, of course, if you sit there and say, well, I'll buy Bitcoin for $100,000, and then somebody goes, yeah, okay, I'll sell you a Bitcoin for $100,000. You have a Bitcoin.
So suddenly I'm sat there with a Bitcoin. I had $100,000.
Yeah.
Which I've given to you.
Yeah.
I'm now holding a Bitcoin,
right? Okay.
Which has a price that might move.
Yeah.
So what do I want to happen?
I want to sell it for 101. Right?
I want to sell it for 101 really quickly.
Yeah.
And
exactly.
so those
as quick as possible. Right.
Those are the two trades that you were talking about.
Yeah, exactly. So if you in an idealistic market making world, which is unfortunately not what the real world is like, you would sit there and say, I would buy for 100 and I will sell for 101, and within no time at all, in an instant, somebody would
come and
sell you a Bitcoin and then buy one from you, right? And you would make one.
And you make that whole spread.
The
spread between where you place these orders.
Where you place the bids and where you place the ask, right?
Okay.
In this side of the book. Now, unfortunately, the real world isn't like that. Okay. And that doesn't happen. And so
it's a bit messier.
A little bit messier. So, of course, the prices are moving.
Yeah.
And so we've talked about what is this price of Bitcoin, and therefore where you place these bids and these asks is constantly being updated. So once you've got what we talked about, once you've got this information in, and you've determined one venue where you're going to place a price, you then basically put your orders in the book, and there's a whole load of technical mechanism of how that is even done.
Okay,
which
it's not always. So say the closest the prices can be on a particular venue are 100 and 101.
Yeah, it's like $1 in it.
You're not always placing your prices at 100 and 101. You might place them somewhere further into the order book.
Could be deeper into the order book.
Okay.
You don't have to place right at the top. Right. So what you're trying to think about, and the way I think about it is, wherever you place an order in a book reflects a probability that you're going to get a fill at that price.
Okay.
Right?
Yep.
And the closer you place to the top of the book, and even through the spread, because we've talked about the spread kind of only being one tick wide, but of course it could trade. The market could be 100 and 105.
Right, and there's space for you to place.
So you could place one at 104. Now, of course, if you place an order at 104, the chance that somebody's going to come and take that bid is much higher than if you place one at 50.
Right.
Of course, no one's going to sell you a Bitcoin for 50 if they can sell you one for 104.
Yeah, okay.
So what you're trying to influence with where you place your orders is this probability, and the probability that you want to fill is not necessarily static either.
Yeah.
Because sometimes you really, really, really want to fill.
Right. In what sort of situation?
Let's say you've got way too much inventory.
Because someone's sold a load of Bitcoin to you.
Someone sold a load of Bitcoin to you, and then all of a sudden the Bitcoin price is crashing.
And so you're directionally exposed. Yeah. And as a market maker, you don't want this.
You're trying not to do that. So you really want to get rid of this Bitcoin.
Inventory. Yep.
And so what you might... I mean, we're talking only about passive liquidity. So this is sort of like placing orders into the book
that aren't executed
immediately. Now, of course, you could take if you wanted to. Yeah. Of course, we, as market makers, do take regularly.
And so this comes back to your probability thing. So if you
taking it gives you a probability of one getting a fill. If the price almost gives you a probability of one, it's much closer to one. Of course, the time of flight.
You might think it's one in your part of the world, but by the time your order gets to
the market's moved.
Yeah. Okay.
So you can't think of taking as giving a probability of one, but it's high. It's a higher probability of getting filled than being right. The other part.
And so to your point about one of the things you think about in terms of determining where you place into these passive orders into the order book is in probability space.
Yeah, I think so.
If you want to guarantee probability, all other things, and speed of light being not consequential and stuff like that, the probability of getting filled is one at the other side of the order book, and then decays
away down as the order book goes. And I think there is a very famous paper that models this decay as being an exponential distribution, which you can fit. So imagine you've got some e to the minus alpha x.
Yeah.
You've got some parameter that you can tweak alpha, and so in some markets it decays really, really quick. If the
Yep.
market's really, really, really tight, and there's loads of size
Right.
at the top of the book,
And so what do we mean by that? So
so the amount of Bitcoin that is available to buy at 100,000 is $1 billion, and the amount of Bitcoin that's available to sell at 101,000 is $1 billion. Then
why are you going to put your order in at 99?
99,
Like, you're never going to.
There's $1 billion worth of volume that has to kind of either be worked through or move.
Yeah. And you see this in traditional financing.
Exactly. FX being the famous
and Treasury futures and stuff like this.
So these extremely liquid markets. Your
large tick sizes, deep liquidity at the top of book.
Exactly. Yeah. So these markets where you're going to have a very, very, very large decay rate on this exponential
probability.
Probability. Let's think about it exponentially decaying way. It's easier to think in exponentials.
So that's going to be interesting, isn't it?
But crypto is a little bit different, right?
Yeah.
Because you can have some very, very thin liquidity. You can have some things that are not very well modelled by an exponential distribution.
Mm-hmm.
Consider, markets where there's a very, very little size inside the spread, but somebody's left a little canary order in there.
Right. And why might they have done that?
Well, to get information before other people. So, even the act of having been traded against gives you a piece of information
you didn't have.
that you didn't have. And so there are these things called canary orders, which you can place inside the spread or whatnot for very, very small size, so they don't have any material impact on your P&L.
On your inventory.
Your inventory. But they might give you information
Something's
earlier because, of course, in general, this is it's a price-time priority, right?
Yep.
And so the price-time priority determines that if you're slightly in front of someone else, you're going to get the fill information first as the matching algorithm. So this is what the exchange is
works through
as it works through the levels, and it matches the orders together to make the trades. So if you've got a very, 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 very small order first, you might get a piece of information
about stuff.
Very, 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 very small, a bit ahead. Very, very small amount of time ahead. And so this could, in theory, give you a piece of information that your system could then say, actually, the market is now moving towards me.
Okay, interesting. And so you have this tension that we're defining or talking about in terms of probability space.
Yeah.
Like close to the top of book, the best bid and the best ask, higher probability that I'm going to get filled. Further away, lower probability that I'm going to get filled. That my job or my desire as a market maker is to get filled.
Or not.
But most of the time I want to participate in trading.
There's a probability for each side as well, right?
Right.
Because obviously, think about the case where you're very, very, when we talked about, you've been sold a load of Bitcoins, the price is going down. Your probability of wanting to buy more Bitcoin is very, very, very low. Mm-hmm. And your probability of wanting to sell them is very high.
Desire or probability?
Desire. Right, okay. And so you modify where you place the orders to modify this probability to match your desire.
Right, okay. So you go, I've got a strong desire to sell some of this because I've picked up a bunch of Bitcoin
so
inventory.
what can I do to increase my probability that I'm going to do? Now, and the highest thing that I could do is take liquidity from the other side.
So not place a passive order at all.
Not place a passive order at all. Just to be precise what I mean by passive order. This is an order that won't cross, it's an order that the trade will not be initiated by you. Mm-hmm. And maybe is the most precise way of saying it. It's an order that only adds liquidity to the book.
Yep.
If that order was actually going to cross, the exchange would reject it.
Yep. Because there are certain order types you can place.
Yeah, exactly.
Where if the conditions when your order arrives at the exchange would cause it to cross, it says, sorry, I'm just going to...
And this is primarily because there's a fee difference, right?
Yeah.
So the taker fees versus the maker fees. So the fee that you pay or even make a rebate on. So we obviously make rebates on some exchanges.
Yep.
Being part of their market maker programs. A taker fee is generally cost.
Yeah,
right. I've never seen a rebate on a taker fee. Have you? I've seen zero taker fees, but I've never seen a rebate.
Never seen a rebate. No, that would be a very good situation.
Yeah, if you want to give me some rebates on taker fees, that'd be amazing.
If any of the exchanges want to call me and offer some taker fee rebates, then you know where to find me. But assuming you don't have an inventory position and
I think it's balanced, right? In some sense.
Which bit?
The probabilities, right? If you don't have an inventory position.
Yes, but there's a tension because you want to retain some spread, and you can only retain some spread if you've actually participated in the trading. Mm-hmm. So in the model that we're describing, you can make the spread that you could potentially retain as big as possible.
Oh, I understand what you're saying, yeah.
Loads of money.
It's a complex problem. It's a complex problem, right? Yeah. Really small spread, high probability is down one end. Really big spread, low probability is down the other end.
Right.
And there's this convex curve, right, which has got some maximum.
Yeah.
of where the probability of being filled and the spread that you capture is just right. It's like the Goldilocks zone.
The Goldilocks zone.
Yeah.
And then this convex problem is changing all the time
with every piece
based
of
on
information.
new information, but you also your inventory and your desire to actually trade or not. Yeah.
And I think one of the key things about market making is this, in a way, doesn't become. So I'm sure that we've got a lot of PhD mathematician listeners who would be thinking, "Oh, it's a convex optimization problem, right?"
Easy.
And I can chuck this into my favorite convex optimization.
What is your favorite convex optimization algorithm?
I don't know, steepest descent.
Okay, nice.
Sure. Whichever, pick one, right? You know, well, I mean, this is active area of ML research, right? You know, what function do you use to traverse through your state space?
Right, but also
not state space, your hypersurface.
I mean, there's the constraint that we operate under, which is you're trying to do this at every single.
Well,
that
that was my point. And so actually, what you end up doing with market making is, it's yes, okay, you could chuck it into some convex optimization solver, you know, CVXPy or Mosaic if you've got a few extra quid, or one of these libraries, and it's gonna do some conic optimization or whatever it's going to be. And you go, great, I found the exact perfect point where I should place my orders to maximize my probability of fill multiplied by the amount of spread that I'm going to capture.
Yep.
And the market was in that state about 10 minutes ago.
That's right.
So, of course, you don't have the time to run any of these fancy...
The luxury to do
that. You have the luxury to run it, I think. And so you have to do it in a more mechanical way.
Okay.
You know, where you have to think about, actually, I don't have time to actually find the perfect point, but can I approximate it well enough?
Yeah. Or can I use historical data to give me an idea of
some numbers I need to multiply together? You essentially have got enough time to multiply some numbers together.
Yeah. Okay.
Maybe divide if you're lucky.
And so you're placing these orders as a market maker in general, you're placing these orders into the market with the intention of retaining some of this spread. And you've got to think about where the probability of you getting filled is versus the size of that spread, and solve this convex optimization problem bounded by the constraints of I've actually picked up inventory where I didn't want inventory, or all my trades have happened on one side of this spread and I've now got to act,
and it's moving in microsecond time,
right?
And so I don't have loads of time to think about what my next move should be from an optimal mathematical sense.
And by the way, you're doing this on 10 venues.
Oh yeah, and by the way, the information that you have might be out of date.
Right. Or no, will be out of date.
It is out of date.
Right.
Sorry, it is out of date. Guaranteed out of date. Okay. Locally, it might be as little out of date as everybody else.
And we're doing this all just to crush some shitcoin. Yeah.
Your shitcoin.
Your shitcoin. Your one.
Yours.
The one you really like.
Yeah.
The one you read the white paper of.
Yeah. The one that you're happy to, because we just love dumping bags.
Yes. So we're going to do this whole spread retention dialogue we're talking about. It's just FUD. It's just like obfuscation.
It's just all bollocks.
Yeah. No. Okay. Beyond this is before we begin to talk about the fact that you might be doing this market making, this liquidity provision, placing these passive orders at more than one level.
Oh yeah, we've only talked about placing one order on one level, right? But of course, there are myriad constraints. So the exchange in of itself might constrain you to what order size you can place.
Okay.
Right, so that's just a straight L1 constraint. Yeah, well, you can't put one particular order that's bigger than X. I mean, because why do casinos...
See exchanges.
Yeah. Well, why do casinos stop you putting the biggest bet on?
Okay.
You know, because there is a reasonable... The exchange have got risk protocols themselves, right? You know, and particularly if we're talking about derivative positions. We're talking about perps in particular.
Okay.
But yeah, I mean, like the casino doesn't let you put on infinite size, right? You just go and double your bet every time.
It doesn't let you do that?
No.
It lets me do that all the
time. You must have a better casino than me. But yeah, so that's a constraint imposed from up high.
Yeah, okay.
Also, there are some other things that you need to consider as well, which is, yes, you might have a real big desire to get out of this Bitcoin position that you've been given, right?
Okay.
Someone sold you a shitload of Bitcoin.
Yeah.
You think the price, you know the price is moving down, right? And so you want to get rid of this stuff. Well, is it the best piece of game theory to show all of your size that you want to do right there? Like, oh my God. Because, of course, somebody else in the market might turn around and go, this guy really wants to get out of the position.
Right. So for clarity...
I can get him out at a worse price because I know that he wants to get out of it. So you might actually reduce the size that you really want to do and split that up into different orders as to not show all of your cards.
Okay. So situation being, or the model we're talking about, say you've picked up a position which is 100 Bitcoin because you've been filled on your buy orders up to 100 Bitcoin, and you haven't had anyone come and act against your sell orders.
No one's bought any Bitcoin off you.
Right, so you're like, okay, I was trying to retain this spread between these two, but all that appears to happen is I picked up inventory now, and that's, from a profit and loss perspective, susceptible to being susceptible to price going up and down. So I need to adjust what's going on these sell orders to try and increase the probability that I can get out of some of this position and hopefully at some point retain some of this.
If it was 100 Bitcoin, you might actually just be hopeful to get out of it for zero.
If it was 100 Bitcoin, then there are other incentives to kick in.
But to your point, that's also another factor to take into play with your own risk limit and stuff, right?
Okay, so possibly shouldn't have got into that position in the first
possibly
place.
Maybe like you...
Or potentially as you got
well,
filled
if you
on
weren't
the
happy
first
to
one.
have 100 Bitcoin, you maybe should have, but you were interested to show that much size, you probably would have spread that through the book, right?
Right. And as you got filled
because of each subsequent fill should in theory be at a larger spread.
From where you're...
Well,
you're going to say fair
I'm going
value?
to say the same fair value, but that's going to open a whole load of kind of worms. Let's just say the top of the book.
Okay, let's just say where you think you could sell.
Yeah.
Okay. And there's a world in which...
Because we're going to do a whole podcast on fair value.
Well, okay, maybe that comes next.
Yeah.
There's a world in which, having been filled at one or two of those first Bitcoins of the 100 that I've like stupidly been filled on, I potentially should have done something with my existing orders.
Should have got rid of the other night, right? Because maybe
should have cancelled those orders.
What your personal risk tolerance, right?
Right.
All of this comes with this added caveat of like you scale as to your personal.
Do we need some proper risk disclaimers on the pod?
Yeah.
None of this is financial advice. Nothing that comes out of my mouth is
Hopefully
financial
we're
advice.
actually putting you off doing market making because it's
Yes.
incredibly hard.
Yes, to do it well is incredibly hard. So, trying to retain a spread, balanced by inventory constraints that you pick up as a result of being present in the order book.
Yeah, which could be to do with your own personal constraints or could be to do with the exchange's constraints.
And then multiply that out across multiple venues, potentially similar product types. So a Bitcoin derivative that sits on top of the spot.
Yeah. Could be a dated future in there.
Could be a dated future in there.
Every single one of these different products needs to be accounted for in a different way.
Right.
Based because they all have different structural payoff profiles, maybe you might say. Okay. Spot being not quite the simplest, probably linear perp being the simplest.
Okay.
Spot comes with some balance issues.
Yeah.
Linear perp's the simplest because it all behaves as you expect in a linear way. It's perpetual, so you don't have to worry about rolling. And you only need a bit of margin to go either side.
I mean, but there are the nuances with perps which like you're glossing over there as well.
Yeah, right? But there's nuances with all of them. But okay, maybe the question is, if I was to, you could only trade one instrument type. What would you trade?
That's fair.
You trade linear perps, right?
Yes, for sure.
But it wouldn't even be a question.
No.
So,
and the thing we're alluding to there is the fact that there's quite a few things. One, you can take long or short positions without needing to have any of the asset to do.
How do you short
so.
Bitcoin spot if you don't?
You can also take positions that sometimes are larger than the actual collateral that you have in the account. Leverage.
Love leverage.
And if you are into the details of things, you can use the funding mechanisms as a way of monetizing some of the balances or collateral that you've got. Basis trade. I mean, I could talk about this to literally.
I know.
Literally,
that's why these episodes are a lot easier. That's how. That's why I always like with these episodes. I'm like, just go for it.
Yeah. So that begins to sort of.
I hope he hasn't done a cut where we gave away all of that free alpha.
All the alpha about our pricing.
I mean, he's been brutally edited it.
Again.
I know this.
We're supposed to be transparent.
I know. He's like cut away. The beers changed him.
and that bit where we showed them how all this money was made on the spread and like how everyone else in the whole ecosystem is so naive.
Yeah. Now we dumped on all these shit coins for profit.
That's exactly what market makers to do. And so no, I mean you alluded to it at the beginning. I think this, in the trading world, in the systematic trading world, of which market making is definitely part of that category because it's
Without shadow of a doubt.
hugely systematic. Like we run everything through through a system.
Well, there's no human. Well, it's interesting, isn't it? There is human intervention, but not in the way that I imagine a lot of people think. There's human intervention because we have some parameters, which we try to make the parameter set as small as possible, that allow us to turn on particular behaviours and turn off particular behaviours. About where we might place and the depth we might place, or some cost hurdles or some spread that we want to achieve. And we can tweak that because ultimately any system, we talked about this, different exponential curves which could define the probability of being filled and how some markets' curves might be very steep and other markets' curves might be less steep. That in effect is a parameter that you could tweak.
Completely.
So there is human intervention in that sense, but other than that, there's no human intervention in
there's no one saying price go up, price go down.
No.
It's a bit sort of more second order than that. And I mean, I guess there's a world in which that will be engineered away over time as well. Risk oversight? I don't think so. I think we always have someone watching the systems because bugs and exchanges.
I've never, ever written a bug in any of my code.
I don't know why you leapt down that so quickly.
Yeah.
But we're dealing with entities that we don't control, like exchanges who do have bugs, for sure, and APIs who go down, for sure. And so we have to have oversight of what's going on in the real time. But we have this idea of it being a systematic strategy, and that classes it within other trading strategies, of which you have discretionary trading strategy, momentum trading strategies.
Yeah, so I would call discretionary not systematic.
Right. It's not systematic, but it's a strategy type.
But you could have something with momentum that's semi-systematic. Yeah. You could have. I would put StatArb, for example, in the systematic category.
Yep.
Any of these things where you're streaming in market data and you are putting it through an algorithm, and the algorithm is deciding where to place the orders, and maybe it's fully systematic if those orders are then placed. And you could call it maybe semi-systematic or discretionary if those orders flash up and you decide whether you're going to place them. Maybe is a very crude way of delineating between the.
Yeah, I could see that. Yeah, and for me, I mean,
I've never worked in a firm that hasn't, where the orders haven't gone in automatically.
Right. Yeah. Okay.
Have you?
Yes. Definitely.
They must be at a frequency that is quite low.
Yeah, low discretionary trading.
Yeah.
I think where
our trades can be inserted and cancelled faster than we can blink our eyes. Yes. So,
for me, where market making strategies, particularly proprietary market making strategies that are not attached to any sort of KPIs or anything, where they are subtly different to all of those other classes of strategies, both just discretionary and systematic, is this idea that you are providing something into a marketplace which is a little bit useful, and yes, you're trying to be compensated it through the spread mechanism that we talked about, and so it is. There's a profit motive there. It's not altruistic in any way, shape, or form, but it's not expressing any sort of view. That's I guess what is different. Like StatArb, you're expressing the view that something's going to revert.
Momentum, you're expressing a view that something's going to continue doing.
Carries,
whatever.
All that sort of stuff. Whereas this is like, okay, I'm going to use my technology, and as you alluded to at the beginning, the risks are different as a result because we're not really.
We have directional risk, but we don't have directional
risk. We're
risk.
not taking a view on direction.
Yeah.
The risk shifts over to much more risk management and tech risk to make sure that all these things that we're doing very, very quickly, probabilities, convex solving, placement of orders, inventory management, all this stuff falls over onto the tech stack that a market maker is building. And as a result, it kind of has maybe I'm wrong, but it has a different feel or a different flavour to it.
It's just a different strategy, isn't it?
Yeah. No, that's what I'm saying. Yeah, but it is. It's a different.
I mean, I think it depends on who you talk to. I think there's a case to be made. It's a service to the market.
That's what I think.
Whereas a taking strategy is not.
Not, yeah. So it's and that's why I like.
But then again, if you run a StatArb taking strategy, who are you taking from?
Are you even a StatArb strategy if you do that, right?
You're taking from a maker.
Yeah.
So.
We are providing a service.
It's all symbiosis, though, isn't it? Right?
Anyway, if you find this sort of stuff interesting, we do, and we can talk about it for ages. We will continue to do this, making a sort of short how to build a market maker in a crypto type series. Feel free to check in for the next one and subscribe.
Like and subscribe.
Like and subscribe.
Thank you.
Thanks.
Cheers.